Local trade, stable so far this morning. The JSE had its best day in more than 4 months on Monday, supported by strong gains in metals. Global markets were firmer as investors welcomed the latest efforts by governments in the US and Europe to ease a crisis threatening the global banking sector. Independent markets analyst Jimmy Moyaha is joining us now for a quick update on how the JSE is faring in early trade. Jimmy, good morning to you. Let's talk about that quick overview of how the JSE is faring so far. Can we use the word stability?
Morning, Claudia. Morning to our viewers. I think it's a bit of an interesting term to want to use at this stage. I mean, we're certainly seeing that markets around the world are still processing bits and pieces of data. We know that we've got the US Fed rates decision coming out later today. We've just had a rates decision come out of, a CPI print come out of the UK. That's not looking good. That looks like they're still battling with inflation. But off the back of that, we saw yesterday that US markets traded in the green, with all major markets finishing up anywhere from around about 1% to 1.5% in the green. We've seen that Asian markets continued that trend, with a lot of them also being up about 1%. I mean, the Nikkei was up about just under 2%. Hang Seng was up about 1.7%. And we've seen that the top 40s opened up about 0.5% to the green, but resources are lacking. They're down about almost 1% at this stage. So I think stable at the moment. It's nice to see that the top 40 and the all share have bounced off of critical support levels, particularly on Monday. But I think it might be a bit too early to say that we are stabilizing at this point for the long term. I think we've still got a couple of things that are going to happen. Like I said, the rates decision out of the US today, we know we've got our own rates decision that looks to have been moved back to next week. Originally, I think from the calendar last year, it was set for this Thursday, but it looks to be happening next week as well. We've got our own CPI print coming out at 10 o'clock today locally, so that'll give some clearer indication around where markets are being positioned at this stage and what we're expecting to see. But it is good to see some positivity at this stage.
Well, let me latch on to that CPI inflation data that you are referring to amid the global financial turmoil. Should we expect any earth-shattering developments there?
Well, we are expecting that our CPI will come in at about 6.9% year on year, but we are expecting that the core CPI month on month will be slightly higher than what we saw last month. So it'll be interesting to see how that read comes through. As I mentioned, at around 9 o'clock, we did get a print from the UK around their CPI numbers, and their CPI has gone up again. I mean, we expected that their CPI was going to sort of come in around 9.9%. It's back above 10%. But even with the CPI print that we're seeing out of the UK, we haven't yet seen signs that the rand is recovering against currencies like the pound and the euro and the dollar. And like I said, we've still got a rates decision out of the US later today, or tonight rather. So it'll be interesting to see how that rates decision then plays into the pricing of the rand, as well as how it plays into the monetary policy decision that we expect to see next week. So today's data from a CPI perspective, coupled with what we're seeing around the world, is probably going to give the Central Bank of South Africa a bit more to think about in terms of what they're going to do from a rates decision perspective.
Let's talk about the United Government or United Kingdom government unexpectedly lifting its ban on Bain and Company bidding for official contracts. This is in the wake of this company having been involved in state capture here in South Africa. What brought this decision about, Jimmy? And the reaction so far, what are you seeing?
So essentially, the lift that's happened is a lift on Bain & Company's international operations, not necessarily Bain & Company South Africa. So it looks as though Bain & Company South Africa is still on the excluded list or banned list until January 2025. But the UK government has basically said that Bain & Company International has cooperated with the investigations, and they've provided a considerable amount of information and evidence of their self-cleansing actions of what took place. So it looks as though the ban is still in place for Bain & Company South Africa, but it's interesting to see that the UK, I think there was a UK parliamentary official who had initially requested this ban, has said that it's a bit too early to lift a ban like this, particularly given that the ban was only imposed in August of last year. Bain & Company, of course, says they regret what happened under the former leadership, and they've taken corrective steps to sort of correct what happened and that sort of thing, but they're still facing a 10-year ban locally. So in South Africa, Bain & Company is still on a 10-year ban, and it looks as though this UK lift is part of their cooperation, and the UK government has also said that alongside this lifted ban, there's going to be continued or enhanced monitoring that they're going to impose on Bain & Company International for the next 2 years. So interesting developments there, considering the fact that we still haven't prosecuted Bain & Company locally for anything that's taken place. And yes, the UK has effectively gone back on part of what they've implemented as recently as August of last year.
Let's conclude the conversation with Transaction Capital's share price, which crashed last week after a profit warning. Now, the group has noted in a further market update that it will not be issuing new shares in order to fund a deal to acquire its further 15% stake in the used vehicle retailer We Buy Cars. Talk us through those developments.
So the development started around September of 2021. The announcement was made that Transaction Capital would acquire the 15% of We Buy Cars, pushing their stake up to about 90%. Initially, that was going to be financed by way of 30% of that was going to be the issuance of shares, and then the remaining 70% was going to be cash from the Transaction Capital team themselves. And in light of the recent share price drop, we saw more than an 80% share price drop at one stage last week. It looks as though it just doesn't make sense for them to issue at this point the shares to finance the transaction. They do still have call and put options in place that they're going to use to effect that transaction, and that's going to be taking place over the next 2 years. So the 15% they're still going to acquire in equal parts over September of 2023 and September of 2024. But I think the decision to not utilize the share issuance model that they had initially outlined in 2021 is largely off the back of where the share price sits now. By issuing more shares, they're going to dilute the share value that is already not trading at the best levels at the moment. So for them, it doesn't make too much sense to go that route. And in not going the route of financing the rest of the transaction in cash, it leaves them with a bit more operating room from a cash perspective. We know that they've already outlined that their earnings are going to be down quite significantly. That's what triggered the initial share price drop last week. So for them to retain some cash on hand is probably a strategic decision at this stage, and the issuance of the share capital is probably not the best timing. So good to see that they're still going ahead with the transaction via other methods that they had originally in place. It'll be interesting to see from a transactional point of view whether or not they do deploy that cash in other strategic methods to aim to balance out what happened to their share price last week.
Jimmy Moyaha is independent market analyst. Thank you very much indeed for your time.